Oklahoma. And by express mail service from your post office, the overnight delivery service that's known for its convenience, economy, and reliability. Express mail service. When we say overnight, we mean overnight.
Wall Street Week with Louis Rukeyser. Brought to you by public television stations. By CSX, the company that puts things in motion. Transportation, energy, properties, and technology. And by Prudential Bates Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. Produced Friday, September 9. Our panelists are Frank Cappiello, Monty Gordon, and Bernadette Murphy. Tonight's special guest is Byron R. Ween, Managing Director, Morgan Stanley and Company.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Listen, you think you had it tough this week? All you had to do was worry about simple stuff like your health and your money and the awful possibility that one of these presidential candidates may actually get elected. Elsewhere, though, genuine disaster was rampant. Suppose, for example, you were American Savings and Loan Association, once the mighty king of the industry. This week, the cause of the most expensive S&L rescue in history. It's going to cost the Federal Home Loan Bank Board $2 billion to unload the red elephant on a group headed by Texan Robert Bass. Mighty humiliating for a California S&L. I suppose you were Drexel Burnham, accused with its elusive Maharaja of junk, Michael Milken, of insider trading and the most sweeping array of other charges in the annals of financial detection. Well, it's almost enough to make a fellow miss a meal. Or just suppose you were Saudi Arabia, once feared by the world for your ability to wreak havoc on toadying Western governments, now watching helplessly as the oil price dived to its lowest since 1986. Why, it was a week in which many of the world's financial titans seemed to be crammed together in a car chauffeured by Mike Tyson. Under the circumstances, then, it's scarcely surprising that Wall Street spent most of its time looking on in mute inaction, as if it were watching the fires at Yellowstone. The total volume of trading was the lowest in nearly 2 years, and the most exciting action, such as it was, came on Friday, when the market first dived on new inflationary fears, spurred by a blip in producer prices, but then, considering, among other things, that falling oil price, turned right around and finished up on the day and the week. The Dow Jones Industrials have now, in fact, been up for 3 straight weeks for the first time all summer. And I'm sure it's just coincidence that after being down each week I was on vacation, they have now been up each week since I returned. But I think I'll stick around for a while. We tonight will talk with one of Wall Street's top strategists on a market that seems to badly need a strategy. But first, let's check out the sleepwalkers in the stock market. And as the Dow Jones Industrial Average indicates, if you follow the theory that the first 4 days after Labor Day give the pattern for the month, you might as well go back to sleep. But despite the ever-vocal Cassandras, the Dow did chalk up a 14-point gain to 2068.81, its best closing in a month. And all the broader market indexes followed suit, reaching their best levels since August 8th or 9th. Our elves are, perhaps appropriately, snoring, leaving their technical market index absolutely unchanged at a mildly bullish +2. Easing interest rates helped the bond market, hurt the dollar, and did nothing for sagging gold and silver. And here's some advice for young American men. If you can't find a drinking partner locally, head for the northern border. A survey reported that only 64% of American women between 18 and 24 years old now drink. In Canada, though, the comparable figure is over 90%. I suppose a gal's got to do something to keep warm. Frank Cappiello, what's this market drinking?
Well, right now, I think it's drinking Alka-Seltzer. The two most interesting things that occurred in the market this week, in a dull, directionless market, were the price of gold and the price of oil. And both of those have cracked. And I think that's very positive for the next couple of weeks. It could awaken the market to the fact that inflation, we passed the peak of inflation, this little bout we had this summer.
Well, Frank, you touch on an interesting point. All kinds of economic theories about how to predict inflation, money supply, interest rates, so on down the line. What you're saying is that the price of two key commodities, gold and oil, are themselves good indicators. Are they reliable, you think?
Gold is a pretty reliable indicator. I know you've had a lot of excuses to ignore gold because of supply and demand considerations, South Africa and so on. But in reality, gold's where the smart money is going, and the smart money hasn't gone into gold for at least 18 months. They've been getting out of gold. And I think unless gold goes up, I wouldn't worry about inflation. I think inflation is no longer a worry.
And that's basically positive for stocks?
Yes, because that means that we've seen the interest rate peak. And if we've seen the interest rate peak, this market is then ready to move to the 2200 area. And that's what I devoutly believe, Lou. Devoutly is the term.
Well, we'll ask Bernadette Murphy because she knows, because she has all the technical equipment to tell us what's really going on in the market.
That's right. And gold has been in a decline, and it's technically it looks like it will probably be going down to approximately the 400 level, maybe a little bit below that. And it's been a trend that's been in existence for a while. The interestingly, last week, a key indicator, short-term indicator, did give a buy on the market. And when that's combined with some of the other indicators...
What's the short-term indicator?
Well, it's the percentage of stocks on the New York Stock Exchange that are below their 10-week moving average. And it went well above 70% and then began to turn up. And that's your buy signal. And it's been confirmed by some other indicators. And so the outlook is not unlike what we had at, in May, near the end of May, which would mean that we could be facing a rally of as much as 200 points in the next month or two.
Bernadette, as you know, I believe devoutly everything that, to use Frank's word, everything that technical analysts tell me. But some of your colleagues this week were saying that the indicators clearly said that the market was going to go down to the low 1900s. Now, are they just looking at different indicators?
Well, perhaps
Or are they stupid?
They are not stupid. Their perspective may just be a little bit off.
Okay, so you and Frank are both reasonably bullish at this point.
Constructive, yes.
Yes. Monty Gordon, do you care to dissent from this?
Not really, no. You can't dissent from it, Lou. It's difficult. But I think that the underlying factor really lies in the sense that the evidence is mounting up that the economy is going to move toward a weaker pattern. The pace of economic activity is going to slow down, which would mean that you probably, as Frank and Bernadette have indicated, seen the peak in interest rates. You may see them a little bit higher. But more important than that, you should see some restoration of confidence. But I don't think the market's going to move on a sustained basis until you have accumulated evidence that the economy has indeed slowed down to a level that is relatively non-inflationary, so to speak.
Monty, I think a lot of people are confused by this yearning in Wall Street for a slower economy. Obviously, lower interest rates are good for stocks, but in the long run, doesn't Wall Street want companies to have good earnings?
Oh, you can have very good earnings at a growth rate of 2.5 to 2.75%. The variation, the thing that you're looking for is not to have an economy that is operating at so high a level that you begin to strain the various resources that are available, create an inflationary pressure, and bring on the excesses that usually result in a recession. What we're really trying to do is avoid a significant recession. No matter what it looks like in the near term in terms of what we're talking about, the real key is to come into a relatively soft landing. There's no question that the economy will face that risk at some particular
How would you
point.
describe the weight of the evidence on that now?
The weight of the evidence on it now is a little bit more encouraging, primarily because it appears that the Federal Reserve did not give ground to all the hysteria that was around. They should tighten dramatically. And I suspect that maintaining a policy of persistent resistance against the inflation will probably bring us to a soft landing.
All righty, in any event, panelists, it's time now to give our viewers an understanding of the deeper things in life. Love, compassion, sacrifice, and, of course, profits. Frank Cappiello, how would you respond to Beverly Sheehan of Springfield, Virginia, who writes me as follows? As a longtime investor in the stock market, I own shares in a variety of companies. Some of these were purchased for potential growth rather than ongoing income. As a result, I find myself receiving dividend checks for such minuscule amounts as 44 cents, 32 cents, and even 12 cents per quarter. It's almost more trouble to cash these than they are worth. In fact, in a recent conversation, a friend told me that she routinely tears up any dividend checks for under $1. This started me thinking. I now wonder how many other investors do not bother cashing the small dividend checks they receive. Do they constitute a sizable number? How much money is unclaimed? What happens to it? Is this situation a problem for any companies?
Well, it's not really a problem, Lou. I checked with two of the largest companies in the United States that also have the largest stockholders, and that's AT&T and GM. And the problem is very modest with them. There is some unclaimed dividends, but very, very small. The U.S. Treasury Department and the SEC, the Securities and Exchange Commission, can't put a figure on it, either the unclaimed dividend total, but they said in all they doubted that it amounted more than $1 million. So it's not a problem. What is interesting is what happens to those dividends. In most states, after 5 years, the dividends revert to the state in which the owner resided when the dividend was being paid. So if you don't claim the dividend, the state will get it, all of the accumulated dividends.
Could endorse it over to your favorite charity.
The state of Maryland.
Is that yours? You do have peculiar taste. Bernadette Murphy, Warren Hall of Mesa, Arizona, wants you elves to get your act together. Some technicians, he says, contend that the overall market trend is negative because the March high in the advanced decline index was not reached during the June-July rally. This is true using the daily advanced decline figures, he says, but he adds, if weekly advanced decline data are used, the June-July high exceeded the March high. So, Bernadette, why don't you explain exactly what an advanced decline index is, how you make use of it, and why one time period is better than another?
The simplest way to structure an advanced decline index is every day determine the differential between the advancing issues and the declining issues, and then you accumulate that figure. The more issues that are advancing during an uptrend, the healthier the trend is and the more profitable. I keep daily, weekly figures. I keep a 5-week moving average and a 25-week moving average on those figures. With any indicator, the longer the time frame that's measured, the more statistically significant is the result. The advanced decline index is an important index. It's one of many that we use. I think it's important. It's sort of like the market's EKG. It gives you a sense of the health of the market.
Okay, Monty Gordon, we got to have heart. Byron Jones of Sparks, Nevada, thinks he sees an investment opportunity arising from this year's drought. The probable need next spring for more than the usual amount of seed for corn, wheat, and other crops. Do you agree? Is there a stock worth buying in this area?
Well, I would certainly agree with the original premise, and there's no question that there will be a need. In the drought, Lou, some of the seed corn crop was also destroyed, so the companies have to rebuild as far as that's concerned. The supplies are limited, and there should be some advantages in that. The companies are optimistic, but the factors won't really pick up until 1990. But herein lies a lesson, Lou. And in our shop, we put it this way. When you see it on the front page of the New York Times, it's too late. The financial markets have already factored this in, so this isn't the time to buy the stocks, particularly except for the very long term. Two stocks are Pioneer Hybrid and DeKalb Genetic Class B.
But you think the idea has dried up?
I think it's blown away for a while.
All righty. Now, if you would like to grow some profits, there's never a shortage of corn around here. And we've got a bunch of clever little sprouts just waiting to germinate in your behalf. Plant you now, dig you later, here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, it seems timely to take one of our periodic looks at how the Dow Jones Industrial Average really is doing when you take those reported figures and shake off the padding of inflation, which always makes the current numbers seem larger than they are. And tonight we're going to add a third measurement, which might be the most useful of all in answering that ever-perplexing question, how high the Dow? First, let's take a look at the official Dow, the one we talk about each week. Our chart begins in 1920 when the Dow was about 100. Its highest point ever came just over a year ago when the Dow closed at 2722.42, and it's now resting at 2068.81. But when you wring out the effects of inflation and look at the Dow in constant 1920 value dollars, in other words, its real buying power, you find that the authentic all-time high was reached back in 1966, that the Dow was lower in 1982 than it was in 1920, and that to set a real inflation-adjusted high this year, it would have to close at, get this, 3609. But while you hold your breath waiting for that happy day, there's a consolation prize. The missing ingredient in both the earlier measurements is that those Dow stocks paid dividends every year, and the real return of investors included those dividends. In a special calculation for this program by our friends at Solomon Brothers, we find that the Dow with dividends reinvested was actually more than 3 times as high as it looked at its peak last year, putting investors comfortably ahead of the game even now. However you figure, though, the last year has scarcely been beer and Skittles for investors in stocks. For some thoughts on the entertainment value of the next 68 years, let's go over now and meet tonight's special guest, Byron R. Wheat. Byron, welcome back.
Nice to be back.
Pleasure to see you. Byron Wing graduated from Harvard with honors in chemistry and physics, but for more than 2 decades, he's been conducting his experiments in Wall Street's laboratories. From Harvard Business School, he went to a 9-year career in Chicago advertising, then entered the investment business, and for the past 3 years now, he's been Morgan Stanley's top strategist for U.S. stocks. He's tonight making his 2nd appearance as my guest on this program. Byron, next month marks the 1st anniversary of Wall Street's nervous breakdown. How long do you think we have to wait for the bull to really start charging again?
Well, I'm hopeful that some of the things that were said during the initial part of the program are going to turn out to be right. I hope interest rates have started to come down, and if that's the case, I think there's a good chance the market can make its way higher. I think the market is very much dependent on the economy slowing and interest rates working their way lower.
Yeah, that's your hope? Is it your expectation?
It is my expectation. I'm not exactly sure that the bond market is permanently headed down from this point. I think there may be a ratchet up in rates, but I think that generally over the next few months you're going to see lower rates.
If I came to you with money over the weekend and said, invest this for me prudently for the future, how would you allocate that money?
I think I would recommend that you put about half of your money, assuming you're, as you appear, put about half of your money in bonds.
What, nuts?
No, comfortable. Half your money in bonds, and the rest in stocks. Although I'd keep some of the stock allocation in reserves, maybe 40% of it in stocks right now and 10% of it in cash.
And how would you distribute that 40%?
Well, the groups that I like right now are very much out of favor in some quarters. One is technology. I definitely think that those are stocks that are very attractive at this point. A second is chemicals. A third is papers. A fourth is emerging growth stocks, and I even like some airlines.
Let's start with technology because it is totally out of favor right now. What are your favorites in that area?
Well, there I like digital equipment and Tandem.
You really are a contrarian because digital equipment this week hit a low since the crash.
Right. Digital equipment is trading below its price on October 19th.
Why do you like it?
I think that investors have lost all confidence whatsoever in what the earnings forecast for digital equipment. I think that as they gather conviction that this company is going to earn $11 in the fiscal year that ends next June, they will pay a higher price for the stock. Right now, the stock is kind of free-floating because investors just don't know what it's going to earn.
You've told us what you like. What don't you like?
I don't like energy stocks. I have been saying for some time that the price of oil is going to come down. It has been coming down. I think that most energy stocks are pretty fully priced, even at $20 oil. I think if oil is going to stay below $15, which I think it is for at least a while, I think energy stocks are pretty fully priced. I also don't like electric utilities. Even though I'm optimistic that interest rates are going to come down, my own feeling is that the electric utility is in a position where it's going to now have to start to re-equip itself, and the various state rate commissions are not quite so generous to the electric utilities as they were early in the 1980s.
Byron, in outlining the reasons for your guarded optimism earlier, you cited only economic factors. Does the election make a difference?
I think the election makes a difference to the market. I think that institutional investors, at least, are very much in the Bush camp. But my own feeling is that economically, it isn't going to make a lot of difference who wins the election. I think that both the candidates will have very little sway over Congress unless they're able to get a large mandate, which I don't really expect. So I think the practical economic effect of one or the other isn't all that great.
Let me bring in my own three candidates, starting with Frank Cappiello.
Thank you, Lou. Byron, in your model portfolio of stocks that you like and buy and sell, absent are small companies, a good participation of small companies.
Well, I think I have a good about 15% of the portfolio in small and medium capitalization growth stocks.
Is that comfortable? Is that where you want to be?
Well, that's in a range of 0 to 20%, so I'm on the upper end of that range, and I'm very optimistic about that group. That group has been was in a bear market from 1983 till the beginning of this year. My feeling is that those stocks are more undervalued than they have been, I think, at almost any time in my career, and I'm very optimistic about the outlook for those companies.
Byron, in your recitation of stocks that you would be a buyer of, you didn't include any financial stocks, yet the financial index recently went on to a new recovery high. Why aren't you including any banks or insurance stocks?
My feeling is that the outlook for the insurance industry is not as favorable as the market is treating it. I think that the underwriting cycle is going against that industry, and my feeling is that the stocks have done extremely well in the face of that, and they're relatively fully priced. I'd rather pick something like technology, where the market has battered that group, and where I think they have undervalued the earnings that I think are going to develop. In the case of the banks, I think the banks are relatively attractive. It's just that I think that there are things that compel me to buy them with greater enthusiasm.
Byron, there's been a lot of talk over the years about the increasing position of institutions in the market.
Mm-hmm.
One of the results of that is, of course, the voting of proxies, as far as various management problems are concerned and various proposals. You took a position on that some time ago. Are you still of a mind that the institutions kind of violate their own requirements and responsibilities?
Well, that's perhaps stating it a little more strongly than I feel it, but I think that institutions are going to have to recognize that they are a potent force and potential force in terms of the administration of companies, and they can't step away from it much longer. Institutions are dominant shareholders in a number of companies, and I think it is in their best interest, as well as the best interest of their constituencies, the pension fund beneficiaries and so forth, for the institutions to act and to devote the proxies in a way that's going to be in the best interest of the ultimate beneficiaries.
Byron, you recently wrote a piece titled Mike Tyson for Federal Reserve Governor. I hasten to point out that was before he cracked up his wife's car. What did you mean by that?
If you remember, at the time that Mike Tyson fought Spinks, the fight lasted 91 seconds while people around the world were watching it on closed-circuit television, and one of the reporters afterwards said to him, Mike, didn't you think you ought to extend the fight a little bit longer in order to provide some entertainment value? And he said, look, I was hired to do a job, and I went in there and did that. My feeling was that part of the Federal Reserve's responsibility is to check the growth of the economy if it's accelerating at too rapid a rate. I thought it was, and so I thought it was important for the Fed to step in and do the job, namely to raise the discount rate.
How about right now? Monetary policy too tight, too loose?
No, I think the Fed has done a good job. I think ultimately they did raise the discount rate, perhaps not when I would have done it, but a month later, and I think that Fed policy has been relatively tight. I think you're beginning to see retail sales soften, auto sales soften, unemployment increase, some of the signs of a softening economy, and that's exactly what I think you need for lower interest rates, and that's exactly what I think you need for the stock market to work its way higher.
We have less than a minute left. We're nearing that one-year anniversary. What have we learned from last October's crash?
One of the things that we've learned when a market gets exceedingly overvalued, as it was a year ago, you've got to learn not to make excuses for it. You've got to learn to not to recognize that you're in a position where you should sell your stocks and assume that something isn't different this time.
But from here, you think we're heading higher? How high this year?
Well, I definitely think we're going to go through 2,200 this year, and maybe as high as 2,400.
Well, thanks very much, Byron Wien. Let's hope you're right. Thanks, too, to our panelists. And now I have two invitations for you. The first is your usual invitation to join us again next week, where my guest will be one of the country's most respected forecasters of interest rates and the economy, Albert Wozenlauer. But I hope you'll join me earlier in the week for a very special one-hour PBS program called Louis Rukeyser's 1988 Election Guide. If you're as tired as I am of the same old superficial coverage of this campaign, this is for you. We'll have the first head-to-head confrontation of the top-level people, specially named for us by George Bush and Michael Dukakis, and authorized to speak for the candidates in three vital areas: economic policy, foreign and defense policy, and social issues. And we'll have some other surprises, including an exclusive poll on how voters are choosing and why, and how they actually feel on the key issues facing America. Most stations will broadcast Louis Rukeyser's 1988 Election Guide this coming Monday night at 9 o'clock. That's 8 Central Time. Check your local listings, and please do vote to join us. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been brought to you by public television stations, by CSX, the company that puts things in motion: transportation, energy, properties, and technology. And by Prudential Bates Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week, Owings Mills, Maryland, 21117. That's $5 to Transcripts, Wall Street Week, Owings Mills, Maryland, 21117. Wall Street Week transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content. You may order by calling the toll-free number on your screen, Louis Rukeyser's Business Almanac. This comprehensive reference with over 700 pages contains many informational charts and statistics. Call 1-800-441-3000 to order your copy. The price is $24.95 plus handling for Louis Rukeyser's Business Almanac. Credit cards accepted.